and welcome you to Tax Year 2025 Advanced Tax Topics Training. So excited to have you. I'm Holly Daniels. I'm the Senior Manager of Volunteer Resources at Prepare and Prosper. And that means that I get to collaborate with Willie and bring y'all training this season. And also, I have the honor of working on all of the volunteer manuals. So I'm sure some of you have picked up your materials in person, and some of you may be looking for the link to the PDF of the tax manual to have tonight. So that's who I am, and I want to introduce our very remarkable and advanced trainer for this evening, the Willie Gregg, who is our Senior Manager of Tax and Financial Services. Willie, thank you so much for doing this.
Hello, everybody. Thanks for coming. Should be good. We'll talk about advanced prepare topics, so this might be new to some people and a bit of a refresher for others, but we'll hopefully learn and open to participation, questions, comments, scenarios you've experienced or encountered in the past. So let's see. Holly, did you want to show them how they could get access to the
Yeah,
volunteer manual
sure.
if they want to digitally? I
Yes,
can stop
absolutely.
sharing for a moment.
Okay, so I'm going to replace the current share with screen two. So, folks, you may recognize the front page of the Prepare and Prosper website. I just want to show you really quickly. I'm going to move this. To get to the volunteer training site, you're looking for training site up here in the top right corner. If you click on that, this is all of the training materials. You're probably going to see basic tax training as your top one. And tonight you'll find materials down in preparers, hybrids, and reviewers down here. So at the top, at the very top, I have the volunteer tax manual, hot off the presses. So we have here, I gave a little tip that if you hit Control F on your keyboard, you can search any term. And then we have a little table of contents for navigating, hopefully easily around. So tonight we're going to spend a lot of time around income, self-employment, right around pages 90 to 130-ish are the pages we're going to spend a lot of time on. We also have, the tax topics activity is going to be linked in here in just a little while. I guess I failed to do that a moment ago. And then obviously when you're ready to get certified, we have some instructions and we have the link here. And that's later on in the season, you're going to find tax tips and huddle notes here, a cute little tax manual archive down here of prior years. So I think that is what I wanted to show y'all for now. And I'm going to stop sharing and pass it back to you, Willie.
Yeah, so that training site that Holly showed you, obviously you can see you can access it from the Prepare and Prosper website, but it will also be one of the 4 pages that will open on all computers throughout tax season. So you have access to all those things, including the manual digitally, if you want to, as well as the other IRS resources, 4012, et cetera, et cetera. So that is one way you can, anybody who prefers to see things digitally, obviously have your physical copy as your in-hand motion. So go forward with that. There may be some other things that come to the training site in the near future, some other reference documents or online training modules that we can take a look at and see again at another point. Let's see. Sorry. Just a moment here. Okay, so back to it again. So we're here to talk about being an advanced preparer and sort of either refreshing, like I said, refresher for people that have been doing so for any number of years, or a nudge in the right direction for somebody who is newer, wants to take on and be an extra asset to the clinic by taking the advanced certification test. I encourage everybody here to do so. We'll talk more about the details of advanced certifying in just a moment. And then we'll go through different types of income, self-employment income, retirement income, capital gains, itemized deductions, and a few other additional advanced topics. So the self-employment income is going to be a decent part of this training since it is the most common and the most frequently seen item at tax clinics. And then everything else is kind of like less and less as the time goes along. So again, feel free to either unmute yourself and ask questions or put them in the chat. I'll ask if Holly can occasionally monitor the chat and go and circle back to things as it makes sense to, either right away or shortly afterwards. So we'll be sure to make it do. And we'll have a activity that I'll touch on a couple times. And well, other than that, let's just jump right in. So why do the advanced certification? It helps more customers. You learn more about taxes, more a variety and wide variety of situations that come up. It really helps keep the tax clinic moving. It's really frustrating when someone with an advanced topic slows down the progress and they have to wait a little longer for advanced preparers. Most advanced topics actually are not really that hard. And a lot of them, there's a little bit of twists and turns, but it can often just come down to data entry like many other tax items. So there's a hype and a big thing built around advanced certifying, but it's really like self-employment can have some twists and turns, but other than that, a lot of the other stuff is pretty straightforward. And it's a bit of an extra challenge to say and learn and figure things out. You get to take on more situations, and then it kind of leads you up towards the road towards, if you're not yet a hybrid or a reviewer, takes on that because you can then take on and check other people's work through the process too. So the basic versus advanced, a lot of the stuff, if you look at the basic side of things, filing status and dependence can be as tricky as anything you see on the right side of the screen. So it's not that if you're not taking the advanced test, you're taking on all simple things, because that can get complicated. Education credits, obviously, can get very complicated. Some Minnesota topics, but in general, on the basic side, it's simple income that is mostly data entry focused. Whereas on the advanced side, there's a little bit more potential challenges. Self-employment, you need to get some information from the taxpayer. Capital gains and stock sales could be a lot of different possible permutations in there, even if most of it ends up being pretty simple. Some retirement income, we'll get into how and why some is basic and some is advanced. And it kind of comes down to, is it really just copying a 1099-R into the software, or there's something else we have to figure out? And then a few other advanced topics that we'll touch on later on. So again, the certification test. So this is just thoughts and reminders on this. There is the website, which was new last year. It is still in place. It actually just looks like it just officially opened today. So it's taken some time, and so it is there. When you're taking the advanced test, reminder that you can, besides the 2 simple quick tests you have to take to get anything else going, you can just go to the advanced test. You don't have to take the basic test first. You can just jump right into the advanced track, where you have to take volunteer standards of conduct, intake interview, and then the advanced test itself. It does cover a wide range of topics that are both advanced and basic. And the test itself covers some topics that are rare to see at sites. So there's one side of things that we may talk about, some things that deal with taking your test. More so in this training, we'll talk about what is more likely to be seen or experienced when you're at the tax site. And so it's a little bit of both, but really we're focusing on what are you more likely going to have to help with. And the biggest topic that we have for advanced tax prep is self-employment. More and more all the time with people having part-time gigs, gig work, the Uber drivers, Lyft drivers, DoorDash, Instacart, all those things. All sorts of different self-employment income that is usually very relatively simple, but can have some occasionally some complicating factors. So we're going to jump into how to go through self-employment. So if someone has income that is considered self-employment for tax purposes, essentially they're working to make a profit. They're working to generate income or revenue of some sort. They need to report all their income from all sources, all types of ways that they receive that income. They will be able to utilize business-related expenses to lower their tax bill, and they will be assessed self-employment taxes if their net self-employment income is over $400. That's where the taxes start to come into play. Related to that, and something that is not as widely known or understood, is that people actually have a filing requirement if they have more than $400 of self-employment income, because there's the potential to then have self-employment taxes come into play. So when we say who has a filing requirement, it's usually the standard deduction for people with standard income sources, W-2s, 1099-Rs, etc. Your filing requirement wouldn't come into play until well over $15,000 for a single person, and this year up to $31,000 for a married couple. However, if somebody has self-employment income, say they have a 1099 NEC with $800 listed on that return, on that tax form, they at that point in time have a filing requirement. They may not have taxes or income. They may have enough expenses to wipe that out or to not deal with that, but technically they have to report it and show that. At Prepare and Prosper, for the self-employment clinic, we have specific tax shifts and days at our main office where they deal with more complicated and higher income sources for self-employment. With significant self-employment, the income guidelines, same guidelines as the regular program. They often serve sole proprietors, individual owners of businesses, independent contractors, single member LLCs, and a wide variety of different professions, massage therapists, artists, barbers or stylists, and even a psychic or two will come and have their taxes done. Then lots of rideshare drivers, lots of Uber, Lyft, and etc. So in the regular clinics, or the clinics that happen all across the metro area, we can do self-employment income of up to $10,000. We're generally focusing on gross income for that, so that it doesn't, even if somebody has $30,000, they have a lot of expenses that brings them below that. It's really just focusing on things that get a little too complicated for our general tax sites. So single income up to $10,000, no net operating loss or NOLs, no depreciation of assets or purchases, no inventory or cost of goods sold, no employees, although there can be contract labor that is paid, but no official employees. Generally, we're looking at one Schedule C at the regular clinics, and then no business use of home. At the SE clinics, at the main office, we can do up to $70,000 of income generally, and a operating loss carry forward. There is depreciation that we can write off for people that have larger purchases of equipment or supplies or such. We can do inventory still, but at the same time, no employees at the regular self-employment clinics, and then more than one Schedule C. And business use of the home is something that is done in the self-employment clinics themselves. Charlie, go ahead.
You mentioned they could have contractors at the PNP regular clinics. They could have the contractors working for them.
It gets a little tricky. I mean, it's basically like you can, but it's just a basic premise of like, is it getting too complicated, or is it getting something that is able to be handled with the training that you have at any point in time? If it seems like it's something that you would think that self-employment clinic should be dealing with, then that is totally a fine thing to
No,
do.
I wasn't actually questioning the complexity. I was more questioning like issuing the 1099s and stuff like
We're
that. They
not we're
have to.
not issuing the
Oh,
1099s.
they have to do that. They have to do that on their own. Got it. Got it.
They have to do that on their own. We can put it on the tax return.
Oh, got it. Got it. Okay.
That
In the business return of the home, I thought we could do this simple version of business return of the home in the regular clinics, like just the. Am I wrong? If I'm wrong, that's fine.
we're
That's
looking to have business use of home all come to the main office,
Oh, okay. I got it. Okay.
just because there are complicating factors like the M1 PR or different components to it, and so we want to make sure that it's done thoroughly and correctly.
Okay.
Things that are out of scope completely for even for self-employment clinics. Again, businesses with actual employees, bartering, and any accrual accounting methods, sale of a business, bankruptcy, whether personal or business, actual car or truck expenses, which we'll get into in a moment, partnerships or entity returns. So if there's more than one owner of the business, it becomes a partnership almost always, except for married couple situations at times. So if anything that is a registered business, partnership, or corporation, we cannot help with that. I mean, if somebody has their, that nonprofit returns, other state returns, cryptocurrencies, actual taxis instead of just Uber, Lyft drivers, and rental property income. Although rental property income, it can get just kind of like send them to the general realm if they own one property and they're renting it out. However, there are situations where rental property can be considered self-employment, and that's a different story. And hobby income is also out of scope, which is tricky because it's basically like the difference between hobby and self-employment income is, are you generating a profit or are you generating revenue that is more than what you would say? So it's just like there's a point in time where somebody needs to start reporting income and not just income and losses. They can't have a loss that extends over too many years. Then the IRS will start to say, you don't have a business, you have a hobby. If you're taking photography and selling some, but you're writing off thousands of dollars of expenses, they're going to say at some point in time, you have a hobby and not a business. Were there some questions that were coming up?
Yeah, Jerry was asking if the income limit for self-employed taxpayers goes from gross income or net income. And Peter was looking for clarification on what COD stands for.
Yeah, great question. So generally for the income limit, we're looking at gross income, just because it's easier to identify quickly. And then also it's easier to generally start to get higher income, and it starts to be more complicated. It's not a general statement, but it's often the case. COD in this respect, we're talking about cancellation of debt. So debts that were forgiven or written off by a company or another person, usually by a company.
Great.
Right. And just to clarify, the page manuals at the top refer to the scope of services chart at this point. So just to clarify out of scope things for self-employment.
Yeah, Charlie has a follow-up question on the hobby income as well.
Yeah.
If someone has income they want to claim as a hobby, i.e. positive net income, couldn't we do that on Schedule 1?
We can. The tricky part is that it's technically out of scope because we're not be able to determine if there's a question about determining it, then it's not supposed to, it is technically out of scope.
What's out of scope? It's out of scope based on the IRS rules.
Yes, correct.
Got it.
Mm-hmm. It's just very rare that it comes up. Usually it's just going to be self-employment. Because it's tricky because the IRS is like, no, you have to report this as business income. No, this is business income. And then at some point in time, they're like, no, this is hobby income. like, well, I'm trying to do what I need to do here. All right, so in keeping the cover this information, if somebody comes in with self-employment income, we do have forms to help them organize their information. So hopefully, to some extent, especially for self-employment clinics, they're done or getting their information ahead of time to try and sort through income and expenses. But at the sites and at all sites, we have both CETO and mini CETO, and CETO stands for Self-Employment Tax Organizer. So this is the mini one, which is just a front and back version, one pager. The CETO is a 4-pager with more complicated items, uh, business use of the home, inventory, cost of goods sold, etc. So in here you can see we just want to collect business information, income from self-employment, whether on forms or separately in cash items, and then expenses start at the bottom of this page and continue on the back side with the most common expenses listed out, categorized as much as possible. Record keeping. To be honest, this is the biggest challenge with self-employment income. It's not really even what is what or sorting through it. It's like, what stage is someone at with all of their information? What questions do you need to ask? What do you need to sort through? What do you need to gather and collect? What do you need to help sort of put back in place? Do you need them to go home and to do some homework and come back? All those are possibilities. Taxpayers themselves need to keep records of income and expenses. There are questions and things that we can do to help recreate records, especially if people get paid in cash or if they have certain expenses that can be recreated, thinking things like mileage or other items that are. So if you're talking income, you want to think about how much were they paid each week, for how many weeks, or are they paid weekly or monthly, or how often did that happen? So as much as you're getting as close as possibly can, knowing that there are some, and the tricky part about this again is that you want to ask the questions, but they need to provide the answers and the information. We can't be feeding them information or feeding them too much. Did this happen or this? You can ask the questions and guide the conversation, but don't try to put numbers down for them. If they say, I made $300 a week for 16 weeks or something, we can add that up and we can come to an estimate. And then you'd want to say, oh, this is what it came to for a total for the year. Does this make sense? Is this something that makes sense to you? And just confirming the information as it comes forward. Usually, almost always, people come with tax forms. And so the challenge is thinking about or going forward with expenses, because as we'll see through self-employment taxes, the more expenses you have, the better off it's going to be. So mileage is going to be a big one, and other things to think about, like did you have, going through and thinking about other expenses. And then for those that didn't keep very good records, to emphasize and really push keeping good records and trying to say if there are resources or other there are a number of apps out there and other different ways to keep track and keep good records on an ongoing basis. And we'll get
Willie,
a little bit. Yep.
How would you answer Shelley's question? Do intake schedulers ask about self-employment and offer materials to help taxpayers gather their records?
They definitely ask about self-employment, and they're trying to especially determine, can we help them in any tax clinic, or do they need to go to self-employment, or are they out of scope? And we can emphasize and try to get them to connect them to resources or forms if they do identify self-employed individuals that can be helped on the spot. But yeah, it may not be as solid in their training, but it definitely would be helpful. I agree with that. All right, self-employment income, just payment for the services that they're providing, sale of goods, commissions, grants, royalties, online funding, and some other sorts of income. There are situations where even selling blood or plasma can be self-employment, selling scrap, things like all sorts of different scenarios. If you're in it for the profit, you're trying to generate revenue, it will often be considered self-employment. To clarify about the online funding, if someone is doing online fundraisers for a business venture, say they're trying to kickstart or get a GoFundMe page for their whatever it might be, their new store, their massage therapy practice. If it's generating revenue for their business, then it will be considered self-employment income. If they're generating money to pay for medical bills or pay for personal expenses or some type of damage to a home or vehicle or something like that, then that is considered a gift to a person directly and not taxable income or self-employment income. So self-employment income records, you have cash receipts, checks, bank records, anything that doesn't come on a tax form needs to be kept as a record, a log book, a spreadsheet, some type of way for somebody to track money coming in. Most common that we see is people being independent contractors or working for others, in which case they'll get some type of or multiple tax forms for that business. Tax form most commonly seen is the 1099 NEC or the non-employee compensation. Usually box 1 will have an amount filled in there, and this is about as straightforward as it gets. If that box number in box 1 is under $10,000 or total of that, then you can move forward with things. If it's $25,000 and you look at it, you can pretty quickly be like, we're not going to be able to help you right now, but we'll have to send you to our main office. So the NEC is the most common, or where self-employment income should be reported for the most part on most situations. The old form where it used to be reported, and every so often where it can still be reported, is on 1099 miscellaneous. Generally, box 3 should be other income, and you can usually count on it being other income and not self-employment, but every once in a while people fill it out wrong. So you still want to ask some questions about what type of income it was. Was it from generating income or revenue or for working or for what it was? Some of the more common 1099 miscellaneouses you might see, there are people who get tribal income from 1099 miscellaneous, and that is not self-employment, and it's considered other income. Medical research studies are not self-employment. They have been clearly decided that they are other income, and just put in the 1099 miscellaneous box 3 and move it forward from there. If something is officially other income and not self-employment, you enter the 1099 miscellaneous as is, and it'll transfer to the 1040 where it needs to go. If it is determined that a 1099 miscellaneous should have been self-employment and should be considered self-employment, then don't enter the 1099 miscellaneous and just put the amount in the Schedule C area and tax layer, because it won't transfer it correctly otherwise. But that's not very common these days. 1099-K is the other tax form that does come to self-employment individuals, most specifically people that are doing Uber or Lyft. There was a mode that the federal government was going through where they're trying to lower the amount that was required to file a 1099-K over the course of many years. They wanted to eventually bring it down to $600, matching the 1099 NEC requirement to file. But now they've reversed course and gone back to the old requirement numbers, which is $20,000 in income and or 200 transactions that happen. So you probably won't see any actually at your tax site because you're looking at 10,000 of income. If you see a 1099-K, that might be an indication that it is out of the realm of most sites. But this is it's technically for third-party network transactions, which is technically what Uber and Lyft are doing. They're not stating that they're employees. They're stating that they're network transactions facilitating payment coming to you. Other people that work in businesses and ventures doing credit card receipts can receive these from PayPal or Venmo or other services as well. Just another thing for 1099 NEC, again, the requirement to file it for 2025 was still $600, but that is also going up starting in tax year 2026 to it's either 2,000 or 2,500. I can't remember which one it is. So that requirement is going up in the years to come. So it won't see as many with such small amounts of it. Doesn't mean that income is not required anymore, required to be reported. All income sources from all points are required to be reported, even if it doesn't generate a tax document like a 1099 NEC. Thanks, Peggy. Confirmed that it was 2,000 for 2026. Thank you. Okay, new this year, and this maybe covered more in updates training, but it's self-employment tip income. Tip income received by self-employed individuals may be deductible if the tip income is included within the income reported on a tax form filed with the IRS, 1099 NEC, K, or miscellaneous. If the taxpayer works in one of the acceptable fields that the IRS has deemed receive tips, so very common fields of receiving tips, restaurant workers, delivery drivers, and Uber and Lyft drivers, certainly massage therapists. There's a long list of acceptable trades or businesses that are likely to receive tips. And if the amount of tips is clearly documented either by the employer or taxpayer. So somebody is an Uber or Lyft driver, that will usually be, Uber especially definitely documents, they don't just document their tips, they often send out a tax form related to tips specifically. So the 1099 NEC can sometimes be just for tips because it is actually processed payments slightly differently. It needs to be reported as income. They will pay self-employment taxes on that amount. They will pay state taxes on that amount if they're over the income threshold to do so. And then they can subtract it off of their federal taxes as a deduction along with or alongside standard deduction. So it doesn't affect their self-employment income or their self-employment tax amount. But again, more on that coming soon. And one other type of income to be aware of is what's called MAPD, or Medical Assistance for Employed Persons with Disabilities. Essentially, this is sort of a work requirement type of situation where somebody is on health insurance, medical assistance, and they are required to work and pay taxes. So they must earn at least $65 a month, $780 a year. Returns like this usually have no expenses, and the expenses actually cannot reduce income below the 65-month amount, or people risk being kicked off their health insurance. So that is not something that anybody wants to have happen. It has to be reported as self-employment. There will be taxes incurred or involved in it. Most of these people know that they have a tax bill coming from the federal side, and they are expecting it and ready to deal with that. The common situation that will happen is someone will come in and say, I've been working for someone else. They say they pay me $75 a month, and I do some paperwork or childcare, or I take care of their dogs or something like that. So if somebody says something like that, you can kind of quickly think of MAEPD, this type of situation. You don't have to remember the name of it, but just like, are you working for your health insurance? And they say, yes, do this. You really just putting the income in a Schedule C, not reporting expenses, and moving the return forward. They'll oftentimes have $900 of self-employment, Social Security benefits, and maybe a renter's credit. And that's usually about it. So don't get too bogged down, and please don't put it in as other income, and try not to go get overboard on trying to find all the expenses that they may have had. So when it comes together, there are self-employment taxes that come with all this income. So self-employment tax covers Social Security and Medicare payroll taxes. It's how individuals pay that. The employee or employer each pays half the taxes, and the employer withholds the employee's share. But on a W-2 situation is taken out regularly through checks, self-employed person pays both halves of the tax, 15.3%. So that is the self-employment taxes that come in on top of income taxes, on top of state taxes. So the more and more income someone's making, the more taxes that come forward with that. So Peter asked, if somebody insists on expenses with MAPD, do you need to prorate the expenses per month? Or it's a yearly reporting. So if they have 1 month that exceeds it, it's basically like they have to come to an average amount of income for the year. So it can be some expenses reported just as long as they have that average total income that they need to have for the year. So the only other time it's prorated is if they only started working partway through the year. So we want to make sure that they understand that they need to report this income in order to stay on their health insurance. So the Schedule SC is the form to claim and file the self-employment tax. Anybody who owes self-employment tax can deduct half of that amount from their taxable income. And it's certainly not uncommon to owe self-employment tax but have no taxable income. That is even at $7,000, $8,000 of self-employment tax income, you're still paying quite a bit in self-employment taxes. So it's not income taxes at that point that's going to get you, it's the self-employment tax itself. And especially for people that are new to self-employment, it can catch people off guard when they have to pay hundreds or thousands of dollars in taxes when they haven't been, in their eyes and in reality, earning very much money. And so it does cause some challenges for people, certainly. And this is, again, kind of within the tax return they have themselves. The standard income would then be used they can subtract adjustments to get to their adjusted gross income. From there, they subtract out standard or itemized deductions. And that can include new deductions that are coming in, no tax on tips, et cetera, this year. That gets you to taxable income. The tax liability then is calculated using tax tables. From there, you can take out the non-refundable credits that reduces tax liability. So there can be people that have their income tax liability dropped all the way down to zero. But at that point in time, then they incur their self-employment taxes. So it comes in after some credits are already dealt with on the tax return. So childcare expenses, other non-refundable credits don't touch self-employment taxes. The only thing that touches self-employment taxes are payments like withholding, estimated payments, or refundable credits like the earned income tax credit. So those are the only things that can affect or alter self-employment taxes. Self-employment health insurance. So if somebody is self-employed, you can deduct up to 100% of their medical insurance premiums from taxable income. They must have a profit from self-employed business. They cannot be eligible for employer subsidized plan. This is not a business expense, but an adjustment off of their income taxes. So just beware of that. Ultimately, if they don't have tax liability, it may not affect, it can lower their AGI, but it's not going to affect it only affects their income tax liability. But it still can be very helpful and worthwhile for so many people. Estimated tax payments, taxpayers may voluntarily make payments, and sometimes it's not really voluntarily. They would risk having additional tax bill or underpayment penalties if they don't utilize the estimated tax payments, if they're regularly going to be expected to have a bill of over $1,000. Payments are made quarterly. Rule of thumb, new business owners should reserve at least 25, if not more than that, to make estimated tax payments during the year. The challenge, of course, is that if people fall behind on their taxes, it's hard to catch up by paying their tax bill in the first place and then deal with estimated payments. But this is a part of having, owning, and running a business, is that the tax bills are going to keep coming. And so it's something that you really want to encourage people to get on top of and get ahead of, and especially by making estimated payments. That is the best way to do so. There is a way in the software for the software to generate what the expected estimated tax bill should be, and they can be paid to both the IRS and to Minnesota Revenue. All right, so you have expenses then. So you want to think about, because you have the income, and you can see the tax. The reason that you want to think about expenses as much as you can, because of the tax amounts and the tax burden that comes with self-employment. So a deductible expense must be ordinary and necessary in the business. Ordinary is expense that is normal and accepted for the industry, and necessary is expense that is helpful and appropriate for the business. So an example we go to is like, if you are someone who paints houses, paint supplies are an ordinary expected business expense. However, if you're a massage therapist and you are painting your studio to make sure that it upkeep and it looks effective and how you want it to be presented, paint is a necessary expense. It's in the upkeep of something of your space. So it can be used on either side of that. So something that is used for your business, expected to be done so, and is of logical and straightforward type of expense. A lot of common expenses, and we don't need to dig in too much here, but you want to think about the types of expenses, but also people should be categorizing their expenses. The IRS wants to see them listed out, not just in a full total amount, but to be put into different common fields, such as advertising, insurance, fees, repairs, supplies, equipment, etc. So that's what the CETO and the mini CETO can really help with in terms of identifying what category something should go into. They can also help to ask the questions, so it sort of triggers people's memory, what type of expenses they had for the business, what type of categories make sense to utilize. Those are the most common categories that people see. The most common type of expense we often see is vehicle expenses. So taxpayers, they do technically have two options in the full tax zone of things. However, Prepare and Prosper and VITA in general will only use the standard mileage rate as the way to deduct vehicle expenses. Standard mileage rate tracks the miles driven for businesses at a flat dollar amount per business mile. It is in scope. Essentially, the standard mileage rate takes into account all of the car's expected expenses. So it's up to 70 cents per mile, which is enough to generally cover gas, expenses, repairs, insurance, all the general costs for upkeep of the vehicle. So if someone asks, well, I have gas, or I have paid for I paid for my car repair or for insurance, you can say, well, we need to focus on mileage and not on all the individual costs for the vehicle itself, because mileage will take those things into account. It's much easier to track. It's much easier to keep a hold of. It's much easier to recreate or to look at and figure out what someone drove for the year. So that people do have, in a general world of taxes, they have the actual expenses that they can use, more common for large vehicles or for different types of driving expenses, but it is out of scope for Prepare and Prosper and VITA services. So we're in standard deduction. The only things that are allowed with the standard miles deduction are parking and tolls while used for business. You can use vehicle loan interest, but it must be prorated to the percentage of business use of the vehicle. And the same thing with personal property taxes on the vehicle. So if somebody drives their vehicle 30% of the year for business mileage, and they can use 30% of those bottom two items. So calculating business mileage really needs to be focused on business to business, business location to business location mileage. So commuting miles are something that everybody has to do and everybody has to take into account for. So if you drive from your home to work, those miles don't count. If you drive from that first work site to another work site, that's when the miles start counting. And then the last trip of the day from your last job site home, those don't count either. So that's what you're talking about for commuting miles. The only exception would be is if you're working way outside of your general work area. If you drive to Rochester for a conference or a meeting or something, then that is no longer commuting. You're going to a specific separate place. But if you're just driving to your first job site, that is not accepted.
Lily, Deb, and Shelley have uncovered the first manual error that we have noticed, which is that on page 94, we are saying that business mileage is 67 cents per mile, but it should be 70 cents per mile for 2025. It's a heartbreaking thing to see the first error, but very helpful as well. So thanks for noticing that.
Yes, absolutely.
All right, I have a question.
Mm-hmm.
If we find any error in the manual, do we come to you or do we just take notes and change it ourselves?
If you find errors in the manual, please email volunteer@prepareandprosper.org, or you can email me directly, holly@prepareandprosper.org, so that I can start a document where I have listed all the errors so that people can go see what they are, or if they find one, go to the document and see if it's already been found.
Right, awesome. And sorry, another question. I thought the self-employment is a separate clinic. Is that something that we have to sign up for, or how does it work? Because I know I'm scheduled with one location, but if I'm interested in doing self-employment, if I do the certification, would I have to reach out to you, or how does it work?
How would you answer that, Willie?
If you're interested, you can reach out to the volunteer department and we'll kind of determine what makes sense as far as certainly open to like coming to the self-employment clinic to shadow, to observe, and then to see about taking it on from there. But it is a specific clinic at our main office. I believe that days are Monday mornings and Wednesday evenings.
Okay, thank you so much.
Mm-hmm. Okay, let's keep moving here. Then along with miles, you have travel. So business travel expenses are deductible when it travels outside of the regular business area for work. Essentially, like you wouldn't be reasonable to go home for lunch. So you need to buy your own lunch, essentially, or stay somewhere. Regular business areas common for workers to commute to and from. So again, if you go to the other side of the metro area, that may still be your regular business area. But if you go to Duluth, that is outside of your regular business area. So deductible expenses at that point in time, transportation costs, including mileage, meals, and lodging if you need to stay overnight somewhere. And if you go as far as flying somewhere, you can certainly take those costs if it's specifically for a business trip and only for a business trip. If you go to Florida for a conference and you stay an extra 5 days, it stops being a business trip at that point in time. But who needs to know that? And clothing, finally, clothing is usually considered a personal expense and is not deductible. However, the deductible clothing items can be things like branded uniforms, costumes for performers, safety clothing, or things that are not generally used outside of the business purposes. So just something to think about. If someone just buys nice clothing to wear for their new job or for their to present professional for their work, that is not considered deductible at that point. Cell phones and internet, usually when you're saying an expense, it's usually all in or all out, but there are things like cell phones and internet costs, some larger items like computers that have both the personal and business use and must be proportioned based on their use, business versus personal. And you'd only enter the calculated business amount in TaxSlayer, and you can ask them, but given, is it about 50, what is the percentage of use? And they're just going to estimate, give their best guess, and that's fine. So for instance, if somebody's cell phone costs $900 for the year, but is used 50% for business, you're going to enter $450 into the software. And a customer must tell us the business percentage. And business use of the home, I know I said it was for the tax clinic, self-employment tax clinics themselves, but we want to make sure we avoid sending people somewhere if they don't need to go somewhere, because that's can be frustrating, as you can imagine. It is a referral to the self-employment clinics, but anyone can screen to see if a customer qualifies. Essentially, the premise here is that the area of the home must be used exclusively and regularly as a part of their business. So if you have an office in your home that you use 100% solely for business, that can be business use of the home. However, if you have a desk set up with a computer or a station that you use for business and your kids use for homework or for when they get home from school, or you use it for any other purposes, that is not exclusively used for business anymore. So it must be both of those things specifically. There are people that go as far as like taping off an area to say, this is my office. That other side of the room is personal use. So then they'd need to take an amount of square footage of the place versus square footage of the whole house itself. And they could get some home items written off for that, rent or mortgage and other utilities and such. But again, it has to be exclusive to business use. All right, so let's do a quick business expenses activity. Let's stop sharing here for a moment.
Hang on just a moment.
So we have just a few things with some questions about business expenses. We'll go through and see where people are at.
Thanks for your patience, friends. This sneaked up on me. All right, the link is in the chat to the activity. And I see a thumbs up if anyone got it open. It's accessible. Okay, thanks.
All right, so if you want to just take a few minutes here and look through just the first page, the three examples of self-employment expenses, about what qualifies and doesn't, or what questions to ask. And then we'll talk about it just in about 5 minutes or so, kind of quickly here. All right, let's go ahead and take a look here and go through this together. So again, we have three scenarios here, just some brief items here. So Lionel has his own photography business, writes the following expenses on the CEDO or self-employment tax organizer. Probably the better question here is which expenses do not qualify at this point in time, because a lot of them are going to be good to go. Does anybody have things that don't qualify?
Is it parking tickets?
Parking tickets do not qualify. Correct.
Yeah, I do not.
You can deduct parking amounts, but not parking tickets. Also, I think people have identified meals while working. So meals while working only qualify if you are away from your regular business area. So if you're traveling or somewhere far away from your general working area, then you can take meals, but not on any regular day. And yes, the community miles do not qualify either, or the personal miles, just the business miles themselves. But for Lionel, everything else qualifies. So the equipment, the software like Acuity Scheduling or Adobe, the props, the website fees, the USB drives, everything else is an expected and ordinary part of a business like that. You hope that somebody is very organized like this and has very specific numbers to write down and has all their stuff. And you want people to put down too much rather than not enough, and to put it in very specific terms as much as possible. Chris asked, with all those expenses, what are the chances he is out of scope with his gross income? It's possible, but it also depends on how successful and how well he can sell his photography. So very much like might end up going to the regular self-employment clinic, but sometimes people invest a lot of money into a business and may or may not actually get enough revenue from it. But it all depends, certainly. You could be well over this amount for regular clinics very easily. Okay, Christine has a full-time job as an employee, but also works as a Lyft driver in the evenings and on weekends to make extra money. She doesn't think she has any expenses to report. What follow-up questions would you ask Christine, and next steps would you advise? Where would you have her go right away to?
See if she's
Mile.
So we're going to go to mileage, obviously, and have her look up her online account to see whatever we can gather from that. As much information, as much resources you can from that resource as you can. Ask her if she bought anything else for the car. Otherwise, the car expenses are very limited from what she can use outside of mileage. But Lyft is going to have a report that she can access, and she needs to be able to do that. And to see if there's any tax form or not. Otherwise, the income will be reported from Lyft itself as well. Some of the other rideshare services don't have nearly as good of a breakdown as Lyft and Uber do. Sometimes DoorDash or Instacart or others are less helpful in that regards. There are ways that people have broken down, even down to the trip trackers that you can find the different information from there, but usually that's may not be as important. On the Lyft and Uber side, sometimes it's about the miles they drove outside of the regular trips as well.
Question.
Yep.
Now, because many people use their personal car for work,
Yep.
how would you, I know we can't advise, how would you tell a person, okay, if let's say they didn't come prepared and they don't have their mileage in place, maybe between their lunch break, they went and just delivered something. And then in the evening they did, like, how would you handle that? And they're like, oh, I probably did this. I probably did that. It makes me wonder.
Yeah, it can be a little tricky. In terms of driving for different services, you want them to go to their account online and try to recreate it as much as possible. If they can find a mileage report through their employer, that'll be very helpful. Otherwise, they may have to do some homework and actually start looking at adding up. If people need to if they drive for another service and have like a regular route they drive, You can recreate that and say like, all right, well, we drove to this place, this place, and this place, and that was a total of 30 miles a day, and I did that 3 times a week or something like that. You can use that to add up total mileage. There can be a number of different strategies for coming to mileage, but you need them to be able to state amount that they're comfortable with, that they can, if need be, substantiate in some way, or make it be alone that if something is asked, then it's on them in order to be able to show the proof that they may need to do so at that point in time. So for rideshare drivers, if their meals are not covered, unless they're, for whatever reason, they're going way out of their work area, which is not really common. So as long as they're staying in their metro area, for example, then they wouldn't be able to deduct meals. It's just similar to all of us, or not all of us, but any employee of a location. If you have to travel to your job already, you don't get to deduct meals just because you're 30 or so miles away from where you live, or you're driving all the way around. So again, in that travel sense, you have to be well outside of your regular work area. Okay, so briefly for Callie, it's a self-employment interpreter and translator, works for several different interpreter placement agencies, often works from home and interpreting virtual meetings. So again, for Callie, the better question again is what is not deductible?
Clothes.
Right, the dress clothes would be one of the big things here. So Deb brought up a good question that you would want to ask is like, it's not outrageous to have that many business miles, but if somebody's usually working from home, then why did they have so many business miles? So it's not uncommon for that to happen, especially if somebody's driving all over the metro area regularly. But it's just about making sure that the situation matches the things that they're bringing up. We're not saying to say 10,000, 15, 20,000 is impossible, but we want to be like, are you sure? Does this match your situation itself?
Yeah, like mostly at the tax clinics, they would have just written total miles. They wouldn't have it broken down.
Yeah.
And then when you further probe, you find out, oh, no, that's your personal miles, or that's,
Mhm. In this situation, the parking fees are deductible because it's parking for the business related purposes. So that would match if they're going to hospitals or downtown or other places to do the interpreting in person. But then again, what are they doing in person versus online? And again, the community in person miles are not deductible. Everything else is deductible. Printer paper, cards, the certification tests, some type of memberships or professional renewal, professional certifications and such, all deductible expenses depending on the business or the world. Again, in general, these are type of workers or situations that come up more often in our self-employment clinics and not as often in the in across the board other ones, but it can and does happen. By far and large, the most common self-employment that comes to all sites are the gig workers, Uber, Lyft, DoorDash, etc.
Can we go back to that Zoom lens for a second? If it was $10,000 and had a life of several years, do we get into something that has to be depreciated?
Yes, if it is a significant purchase like that, items that are under, I believe, 2,500 can just be written off as an expense. You have the option to do one or the other. You can expense them as a depreciated item, or you can write it off. But anything that's over $2,500 has to be depreciated, I believe.
Okay.
You're starting into that realm, definitely. And that's when it just gets a little complicated and out of the to go to self-employment at that point. Okay, so that should about wrap up self-employment. Again, most of the stuff we see at tax sites are pretty straightforward. Anything that gets too complicated can be referred to our self-employment clinic. But the last thing I'll say about self-employment again, though, is that people will just be like, "Oh, I just don't have anything. I don't have, I don't want to deal with it or worry about it." But there are a lot of situations where that's not, like people have mileage, people have something, they just have to put a little time into it. And in the end, could save quite a bit of money. There are situations where somebody really contracted for someone else. They paid for about everything. They did everything. They drove from their home to one work site and back home again. And so there may be times with limited to no expenses, but in general, there may be times where like a few more questions, a few more trying to pull out some information from people can be very helpful to their overall final tax situation. All right, well, let's shift into retirement income then. So retirement income is the next most common advanced topic, although most of the time we see it as actually a basic topic. It's just occasionally an advanced topic. It's advanced when the taxable amount in box 2A on a 1099-R form is blank, or the taxable amount is marked as not determined. So it's generally when there is additional calculations that need to happen, such as the simplified method. And then also if the taxpayer is eligible to exclude early distribution penalties. They take money out early and they can take an exception to that penalty that may come up. The simplified method is something that is tested on in the advanced test, but it comes up very rarely overall at sites. Just the customer base that we work with, generally pretty much all of their retirement income that comes in a regular fashion is going to be taxable, or the taxable amount has been determined.
Willie, we have a quick question from Peter back on self-employment.
Yep.
If the customer tells us they don't have a receipt, should we not claim a business expense on the return or let them decide?
That is the golden question, the one that really matters. In general, we'd say no. To think about, there may be other ways to substantiate, like asking the questions of, do they have an account at a business, Home Depot or such? It's not as common for what people were working with. Is there any way to substantiate? A credit card statement is not really going to cut it per se, but might be something in that realm. I mean, honestly, it's really a little bit like the official answer is no, but the real answer is like if they have 8,000 of income and they're trying to write off an expense of a couple $100s, then there's nothing to worry about there. Then that's expected to have expenses, and it's in the realm of what they would be doing. It's really about combination of thinking about things. Does it make sense? Does it in line with what someone should be doing or having? If they're trying to write off something big and outrageous, then absolutely they need a receipt for it. But if they're trying to just, I bought some whatever work boots for a couple $100s, and I'm not sure if I have the receipt or not, then there's generally just not a problem with putting that down. But the more standard official statement would be they need to have a way of showing their amounts they owe. So really, it is the question to ask, obviously, and it's a tricky one at times. There's not going to be any problem with small amounts of expenses incurred or received as long as it doesn't get outside of a realm of bounds of that. So sorry for the vague answer.
Peter says it was very helpful.
Yeah. Okay, so types of retirement income distributions that come from employer or one that they open on their own. 1099-R codes in box 7 identify the type of distribution. Some of those codes are out of scope for VITA. Be alert to that, especially code J is one of the more common ones. So be alert to if we can't do it at all. And it can also transfer the distribution to other parts of the software if needed. So look at it early in the process. Most common code is 7 for regular distribution. Some are out of scope, code J, T, and others. Codes 1 and 2 indicate an early distribution and may cause a penalty. And occasionally they are combined as a letter and a number or 2 letters. And that just means that there is early and a different type of a distribution, as an example. So if someone has an early distribution, they're technically will have an early distribution generally if the taxpayer is under 59 and a half years old and the financial institution has no known exception to that. These distributions are subject to a 10% additional tax penalty alongside and on top of their regular income taxes they pay, their state taxes they pay. So taking an early distribution can have 10% here, 10% there, 5% there, and add up to 25 to 30 or more percent of taxes taken out for it. There are a list of exceptions that people can claim and take out. There are a more expanded amount on page 79 of our manual, as well as a full list in the 4012 on page H7. When somebody has an early distribution like this, one of the things I like to do is take actually the 4012, go to that page H7 and look at it together to see if anything does qualify or they qualify for anything specifically. So our manual is going to have some of the examples and the full list will be in the 4012. Exemptions new as of last year, up to $1,000 can be exempt due to personal emergency expenses. On 79, there is a bit of an expansion on that, what that means. You can take one emergency withdrawal per year. After the withdrawal, the account must have at least $1,000 remaining, so you can't take out all of your money from the retirement account and use that expense or use this early distribution. And some other qualifications in there. As well as there are some things like up to 10,000 can be exempt to domestic violence related distribution. So that's why, again, looking through it and talking in a very understanding and respectful manner can get it to see, do any of these items qualify? Does any of these items relate to you and your situation? So you don't have to be it can be kind of like based on what is in the book, point out certain things or look at this list and see if anything qualifies to you. So as an example to that, Rod is 42 years old, had a major emergency car repair that does qualify as an emergency expense. Took $3,000 out of his 401k to pay for it. His $30,000 early distribution is included in Rod's income to figure his income tax. He can use an exemption on $1,000 of the distribution. A penalty of $200 is applied. So instead of $300 penalty, it's down to $200. Cal is 38 years old. He is in grad school and took $5,100 IOA to pay tuition. The $5,100 early distribution is included in Cal's income to figure his income tax, but he can use the exemption on the 10% tax because of the higher education paid with early distributions. So those are some examples. Otherwise, he would have had a $510 penalty to pay.
Can he also Willie, can he also use the same education money
He
for
can
education
actually do
tax credit?
that.
Oh,
Yes, he
interesting.
can.
All right.
Which I believe may, or just to leave it at that. He can use
Okay.
that for tech education credits as well.
Cool.
Box 3 in disability in a 1099-R. Code 3 indicates a distribution related to a disability. The income can be considered earned income if the taxpayer has not reached minimum retirement age, which is specified by their employer plan guidelines. So you can ask taxpayer if their minimum retirement age is at their employer, but this can be, so on occasion you see this as someone's only taxable income, $14,000 of 1099-R income code 3. If they're a single person, 57 years old, under retirement age, it can be considered can be considered earned income and qualify them for the earned income tax credit, actually. Because essentially, this is disability earned from their employer for an early being disabled before retirement age came about. Just to be aware of that. Code G and rollovers. Distribution from Code G in Box 7 indicates a direct rollover going from one financial institution to another. None of the distribution is taxable. It should not go or show up anywhere besides in the tax exempt part of the retirement indication on the 1040. In TaxSlayer, beware though that you'll put in the code, put in everything in the 1099-R in the middle of the text, in the TaxSlayer section of that code, there is a point where you have to check that it is a rollover and put the amount in still, even with code G listed in there. But this will have, nothing will be listed in box 2. It is not an advanced topic. It's just to be aware of. Taxpayers can roll over distributions on their own, but it has to be done within 60 days of receiving the money. So sometimes people move on from their job and they get distributed money and they didn't really want it to happen, but it did. And they would have to roll over that money and show documentation of doing that within 60 days of getting the money. Okay, using the simplified method. So if the taxable amount not determined box is checked on the 1099-R, you'd want to look at, is the amount in box 2 entered? Is there something in that box? And is it the same as box 1 for gross income? If that is, it's most likely the case that it's all taxable. If the taxable amount is blank, what is the distribution code? If it's G, then it's a rollover and nothing to worry about. If it's 7 something else, then it may need to use the simplified method. And then is there an amount in box 9B, which is for employee contributions? If taxable amount is blank, taxable amount not determined is checked, and the amount in 9B, then the simplified method is needed to go through in TaxSlayer. Pages 66, 76, and 77 have a detailed, definite way of going through the simplified method in the software, and be sure that it is done. Otherwise, the 4012 does as well. And like I said, it will be tested in the certification test. Hub 4012, another good place to go to. The information that will be needed is the start date of receiving the pension. All other details can be determined from the 1099 or from calculations. Having info from previous year is helpful. You would need to note if it was a joint or surviving pension or not, or single individual person, and what the retirement age is collectively. Remembering that the the figuring out the ages is something to be aware of as far as when all that happened. So be alert to what someone's age is at that point in time. Okay, and then finally, briefly, lump sum Social Security benefits, not retirement, but not in a 1099-R form. Some individuals receive a lump sum when starting to receive Social Security benefits. Form SSI shows a total in box 5. In the bottom left corner, the amount would list the amount applicable to previous years. So essentially, people who receive lump sum payments when they were applying for or trying to collect Social Security, sometimes often in a disability sense, and it gets denied, or it takes years for it to go through and be approved. Sometimes 2 to 3, sometimes 4 to 5 years, at which point in time they back pay for all the years that you should have been receiving, or from when you started applying for the Social Security benefits itself. So you may receive 2, 3, 4, 5 years of payments in one lump sum. So $30,000, $40,000, $50,000 at once.
At the movie on the Christmas Story, I think.
You can then report the income. You'd report the income in the current year or the year it's been taxed, and then there's a way to distribute them backwards, but you're not doing it by amending tax returns. You're doing it by taking information from their previous year's tax returns and putting it in to see if they got this income during those years, would it have been taxed? So the basic way to go forward is put the income in all at once. See, does it make a tax liability, or does it incur them taxes that they have to pay? And then you would want to go forward and see, do you have tax years that you can go back with? Otherwise, someone might have to come back with their prior year tax returns and to see about distributing it backwards. Certainly something that can be inquired through a manager or other experienced people if it comes up. Doesn't come up very often, but it is a fun exploration. Just so you know, that total from box 5 has to be included in the M1 PR, so it does not affect that calculation in any way. Okay, let's go ahead and take a break. All right, let's jump back in, keep things moving. Thank you all again. Okay, so moving on from two of our more common items to some still common but somewhat less seen items. Other advanced topics include capital gains and losses. Something you may not see until mid-February from there forward, but anybody who has investments, stock sales, even though that can be oftentimes just data entry, is still actually an advanced topic. Sale of capital assets, stocks, bonds, real estate, capital gains or losses, reported on Schedule D in Form 8949. You need to know the cost basis and the proceeds from the sale and the holding period. So short-term investments have been held 1 year or less, long-term investments held more than a year. Most come on 1099-B forms, and they're much more helpful when they do, and we should be utilizing those especially. You need to know the type of stock, holding period, cost of proceeds. Ultimately, it can be best practice to enter all transactions individually. However, if there are numerous or a number of different transactions, we are fine using the summary form to do so. But you need to separate things from short and long term, and must be separated out if it's reported to the IRS or not. So making sure you're entering those separately. Data entry errors are more common when entering more data, and it's easier to review and to look through. Just with that, ultimately, we're just not going to spend too much of our time entering transactions over and over and over again. Just make sure they have a copy of that if needed, if the question's asked, but usually that should be just fine. When you do enter summary items in the software, it'll ask for a date. You can ask for, say, that various selling periods, and you can usually just either put one of the more common dates or the last day of the year for when things were sold for that. If you need to determine cost basis, it is the original purchase price, can also include dividend reinvestments or improvements to properties. Generally reported on 1099-B is much better than how it may have been a number of years ago when a lot of things were left blank as far as cost basis. If there are times when it had come down to looking up costs, original costs of the day when it was purchased online to say, this stock costs this much at this day, and having to figure that out. But that is very rare at this point in time. Inherited stocks, you're looking at the cost basis as the fair market value at the time of the owner's death for the person that is inheriting the stock, and is considered a long term. There are exceptions to those, but they are common and out of scope at Prepare and Prosper. So essentially, if someone dies and someone sells stock relatively soon afterwards, you're generally not dealing with much cost basis or dealing with much gain or loss because it's going to be very similar to the time at the owner's death. Capital loss carryover, when transactions totaled together result in a loss, only $3,000 can be utilized per tax year. Losses of over $3,000 carried over to future years, and $3,000 per year can be used as a total loss. And you have to add up and make sure you know what the every year's addition or subtraction to that loss is, but in a total of 3,000 loss can be reported each year. A worksheet from a prior year really helps. We just need to know what the total amount was. You get 3,000 total, but if there's more than that, you need to know it so that you can continue to roll it forward. So someone has a total of $15,000 of losses. You need to put 15,000 into the software in terms of capital carry forward so that it then takes the 3,000 from that and tells you how much is remaining to use in future years. And if a year is not used, it should be considered to have been used, even if it wasn't accounted for. It's supposed to be used every year. Out of scope capital gains. All virtual currency transactions are out of scope, and a gain from the sale of personal property. But however, personal property is sold at a loss does not need to be reported. So if somebody bought a car and then sold it for more than it was worth, or more than what they purchased it for, then that would be a out of scope capital gain, personal trans. It gets touchy because sometimes you can do things like fix up furniture and such, and it can be considered self-employment instead of a capital gain. But it's a matter of like, is this a business venture or is this something that you're just selling personal property at that point in time? Almost all personal property is sold at a loss, as most of you probably know. And proceeds from a garage sale are not income because you're not making, is a rare time that you make any profit. And you're not talking about making money here. You're talking about selling something for more than what you purchased it for or what the value of it was when you acquired it. So if you have a lamp or something you paid $25 for and you sell it for $5, you don't report the $5. You don't have to report anything at that point in time. A sale of a main home, gains from the sale of a main home usually don't need to report it on federal and state income taxes. However, the gains are considered household income on Form M1PR, just to be aware of that. There are gains that are excluded from taxable income if the gain itself is $250,000 or less, $500,000 if married filing jointly. As long as the taxpayer owned and lived in the house for at least 2 years or considers it their main home for that time. So again, this is just not going to be something that is a big factor, but it is a part of the M1PR calculation if somebody makes a gain on a sale of a home. There are ways to enter this into TaxSlayer if need be to make sure that it is considered non-taxable, but still reported. Foreclosure referrals refer taxpayers to foreclosure to self-employment clinic. Income comes when the foreclosure is finalized and the debt is forgiven. It may come with 1099A and 1099C foreclosure forms. Again, as long as it was their main home, they're usually not having to include this in income in any sort of way. But if they don't report it in that way, all of a sudden the IRS can say you have $250,000 of income you didn't report. You have to say, whoa, I should put that in writing some way to say it's non-taxable loss of or cancellation of debt or whatever it might be. Okay, so again, capital gains are usually simple and straightforward on 1099B forms. Enter the summary if need be and move on from there. So a lot of data entry, but can be in there. Itemized deductions, another advanced topic, something that we just see very rarely these days, almost never, but it's something that does come, people come with documents to say, I have these expenses, what should I do with them? Something that was much more common a number of years ago and now is significantly less so. So most of you know you either take standard or itemized deductions. They are subtracted from AGI to calculate taxable income. Tax should use the best tax benefit, and it's almost always the standard deduction. So people will ask questions like, well, I have these medical expenses, or I donated to charity, and you can say, well, charitable donations, you may take a subtraction from Minnesota. Medical expenses, it's just not going to likely to add up to enough to go and go over your standard deduction amount. This year, the standard deduction actually went up from where it was stated to go, even in the federal legislation that passed in July, it went up even more. So these are the current amounts of what someone gets automatically. They would need itemized deductions to exceed this amount to start being able to make sense to utilize. And people who are 65 and older or blind get additional deduction here. They get even more deductions for being a senior this year, but those are actually not considered part of the standard deduction. They're an additional deduction, which we talked about. Although the Minnesota standard deduction is slightly different in 2025, the reason for that is that these amounts are based on federal legislation passed in July. The state did not conform to those changes made at that point in time, so their standard deduction is actually a little bit lower right now. Itemize allows people to take specific expenses and write them off. Mortgage interest, property taxes, very high unreimbursed medical expenses or large charitable donations as very common ones. But there must be higher than the standard deduction for the taxpayer to benefit, and that just doesn't happen very often now. Medical expenses, they must reach a minimum of 7.5% of their AGI to start using deductions. So every dollar over that amount can be started to use as a deduction. Mortgage interest and property taxes on their home, charitable donations, cash or donated items, however, over $500 of non-cash is out of scope, and that needs to be based on the fair market value of those items, not what people think they're actually worth. Gambling losses, but only up to the amount of winnings reported. This actually can be one of the times that people do itemize, is if they have $30,000 of gambling winnings they're trying to report, and they have statements or ways of showing they had at least $30,000 of losses. That would get them right up over their standard deduction amount if they're single pretty quickly. But that's not very common either. Itemized deductions are rarely used. Customers often answer yes to the questions on the IRS intake sheet and bring in documentation of deductions, but that's when you just explain that you are getting a deduction that is greater than what this all adds up to. Most likely to itemize include high gambling winnings and losses, and some people, for instance, who are in a nursing home, or a spouse is in a nursing home and they have really high medical expenses, like many tens of thousands of dollars.
They have to pay the medical expenses though, right?
Correct.
It's not just the bills. Yeah.
Yeah, they have to pay them, or be in they have to pay them, correct.
Willie, we have a question from Peter in the chat, but I'm not sure I understand what he's asking. You probably do.
Or I can, Willie, I'm just wondering if someone tries to get creative, are we going to allow them to itemize to take that if they pay their 2026 taxes before the end of this calendar year, even though they don't have the statement for pay 26? Or just deal with that if it happens?
I would just deal with that if it happens.
Perfect.
I'm not sure the correct answer to that. I know it was coming up, but I don't remember what it was. All right, we might do just to quickly do a the question was about the deductions related to state taxes increase from 10 to 40,000. I don't remember what I definitely know it was a part of the discussion. It was the SALT, or the state and local taxes. Essentially, taxes paid withheld from your checks can be deductible, paid to Minnesota, or state taxes, income taxes, or state property taxes. But there was a cap before previously of $10,000, and now it may have been increased through the latest bill up to potentially $40,000. But we rarely ever see people with that much of state and local taxes. All right, just briefly, we'll just do this activity. Or did I close it out already?
There's the link in the chat again if you need.
Thank you. So the thing about itemized deductions is that when people bring things in, it's not usually about trying to add them up and trying to see if they're getting close. It really is like taking a quick glance at things and seeing, is it worth my time to even start to do so? So we'll just take a couple examples of those and kind of go through that. So there's the thing again you can go through. So if you look at this activity here and see, like, Jaden files his own taxes, his total income is $36,000 from his job. He had $1,300 in Minnesota tax withheld, as potentially he shares that he paid these amounts in deductible expenses. Just glancing at it here, do you think it's worth to even try to add them up? Or ask him about additional follow-up questions? Essentially, within this, he didn't really even pay enough to even consider it as a possibility. So there may be times when people get close and you want to test it out to see, is there enough, or are there enough items in place? But in this situation, there's just not enough to even bother doing the math or trying to figure out. Remember, his standard deduction is going to be $15,750. So there's not enough to indicate a possibility there. However, you have Yvette and Tony. Yvette is helping her mother, Tony, with her taxes. She has an IRS power of attorney. Tony's income from a pension and Social Security. Pension is $25,000 fully taxable. She has $3,000 of taxable Social Security. Tony moved into a nursing home this year and had significant medical expenses. Documentation of these expenses. So this might be something to where it's worth entering into the software and seeing what it comes out as, because we don't know. It's hard to see right off the bat, but you can already see $18,000 in nursing home costs, $9,000 in medical expenses, a few other thousand here and there. Enter that in. Is it enough? Is it not? It's not about identifying here now, but is it worth it going through the venture to ask the questions, to figure things out, to enter things into the software? Because for other things, it's not even worth the data entry side or time of it. And then finally, Crystal and Damien. Crystal and Damien filed jointly, renters, and have a total of $49,000 in income from their 2 jobs. They donated $600 in cash to charity, and they have helped a friend by donating $100 to a GoFundMe page. When the friend's house burned down, they paid some medical expenses, but aren't sure, blah, blah, blah. There's nothing here to even start the process. However, you have the $600 in charitable donations that you can still put into the federal side to get a charitable expense for the state, the subtraction. And just so you know, the $100 donated to a friend is not deductible in any way because it's not a charitable organization, but a gift to a friend. Okay. So that's just, again, itemized deductions is often about, is it worth even starting to try to do it?
Hey, Willie, are the
Yep.
nursing home costs, is that like a separate category or is that just considered another medical expense?
Generally considered a medical expense. They may break it down. There could be some rent amount that is paid, but that's usually very minimal. But essentially, nursing home costs are deductible as medical expenses,
Okay, thanks.
which can add up very fast, very quickly. All right, so another topic is health savings accounts. They used to be their own certification test altogether, and now have been folded into the advanced test for a number of years now. So it's a part of the full advanced certification. HSA is a medical savings account to pay for current or future medical expenses on a tax, or the money's taken out on tax-free basis. Account is owned by an individual. Contributions can be made by an individual, employer, or any other person. And as long as the distributions are made for medical purposes, they are not taxable at that point. Excuse me. The benefits are their contributions are tax-free, the payroll deduction, and any contributions made with post-tax dollars outside of your employer can be eligible for an adjustment on your taxes. Unused funds remain in account from year to year and do not expire, can be used as a savings account for future retirement, if even to that level. Interest and earnings on the assets grow tax-free, as long as, again, distributions are used for qualified medical expenses. They're not taxable. So the way to determine is a question on the intake sheet. Again, this is where a lot of the things get identified as far as advanced topics. Did they have any contributions or distributions? Code W on a W-2 would indicate HSA contributions through your employer made by either or both you or your employer. A 1099 this is a 5498 SA, would list the total contributions for the year and the fair market value of your HSA. Occasionally, the total amount here can be slightly different than on the W-2. We wouldn't worry too much. You can ask them just to confirm if they made any contributions outside of their employer, and usually the answer is no. And then the 1099 SSA is about distributions or money spent from the account in the year. And as just want to ask or verify if they spent that amount or that much on medical expenses. Medical expenses are a little more broad in the HSA side of things. It can include some items, over-the-counter items from pharmacy or from other locations, but generally medical costs, prescriptions, etc. Eligible individuals covered by a high deductible health plan, not covered by other health insurance, not enrolled in Medicare, and not claimed on someone else's tax return. For a married individual, each spouse must be an eligible individual and they must open a separate HSA. They cannot have a joint SA, however, distributions can cover the expenses of the other spouse. So they may not be technically both owners, but just money can be covered for any spouse or dependents on the tax return. Contributions are limited for 25, I believe it was 4,300 for self, 8,550 for family, and if anyone's age 55 or older, you can get an additional $1,000. Those amounts will go up for tax year 2026. Taxpayers with excess contributions must withdraw the excess. This is out of scope for VITA. Strongly consider, but essentially these contributions in excess and items are for or through April 15th of next year. And so you can consider them as being contributions at that up until that point in time for the tax year 2025. So someone, if they donated too much money or put in too much money, they would still have time to withdraw it by April 15th, I believe. Distributions, again, as long as they're used to or qualified medical expenses, they're not required to take an annual distribution, can be made to pay expenses for taxpayer, spouse, or dependents. And both the manual and the 4012 especially has a more comprehensive list of what is considered a medical expense. There may be a question that you asked about, so you want to be sure you're getting that answer correct. But in general, at the tax site, we're just saying, did you use them for medical expenses? You don't need to see proof of that. The answer is almost always yes, and it's all then not taxable. Doctor, hospital visits, dental visits, medical equipment, prescription, and over-the-counter medicines can be used as qualified expenses. Gym memberships and sports expenses are not qualifying expenses. Okay, premium tax credit. So we're just kind of going through a number of the different possible advanced topics here. Again, some of these you'll be tested on, some of these you'll see at the site, some you may never see at the site, but you'll be tested on. Some you won't be tested on and you'll see it often at the site. It's just how it shakes out. Premium tax credit is not as common a thing. However, does it really important that you understand the concept of it, because it is the basis of the health insurance question that is asked for every single taxpayer. So premium tax credit is from and derives from Form 1095A. So premium tax credit itself is a credit that people get to help them pay for their health insurance. It is really the crux of the latest government shutdown and all the big stuff that's happening in Congress is to help keep expanded premium tax credits as well as premium tax credit cliffs. Those won't apply this year. However, there will be, if they don't pass any legislation, there will be things that will happen based on tax year 2026 and how people are set up for that. So right now we don't have clear, we may have some guidance for you to how to have conversations with people about changes to health insurance laws or lack thereof, or changes to how the credit will work in the future, because it's going to be problematic for some people and some people very problematic. But again, premium tax credit Form 1095A is less than 100 of our tax customers, and we serve nearly 10,000 people. So it is a small percentage, but you do need to ask these questions to everybody. The premium tax credit is refundable and lowers the cost of health insurance purchased through MNsure. MNsure coverage is available at metal level plans, bronze, silver, gold, or platinum. Minnesota Care and medical assistance plans do not qualify for this credit. They may go through the application or be routed to that application through the MNsure website. So when we ask people, did you purchase health insurance through the marketplace is MNsure. However, some people go through MNsure and get routed to state health insurance plans. So when you ask them, you want to ask, are you on state or county health insurance? And if they say yes, then they're not on the marketplace. If they have health insurance through their employer, they're not on the marketplace. If they went to the MNsure website, purchased a silver, gold, or platinum plan, pay more than usually $120, sometimes quite a bit more, then they're likely on health insurance through MNsure. Minnesota Care medical assistance is a free plan. Minnesota Care does often have a cost, but it's usually under $100 per month per person. At least it was before, but it should be around that now. Having someone tell you what insurance company they get is not necessarily helpful, because there are insurance companies, Blue Cross Blue Shield or any others, that have both Minnesota Care medical assistance plans as well as MNsure marketplace plans. So it's just different plans for different people at different levels. If an insurance card says MHCP or Minnesota Healthcare Plan, that is state coverage and is not marketplace coverage. So just some little tricks to go through, because what we want to avoid through this is, number one, not sending people away to say you need a tax form when they don't need a tax form. Because if they're not marketplace coverage, they don't need 1095A. And it's frustrating to be told you need to go get a tax form when you don't need a tax form. And then they have to come back, etc. The form 1095A can be looked up online if someone does have it. The other thing we want to avoid, though, is that if someone does need the 1095A, that we have them get that, because their return will actually reject and say, you need to have this form on this form now. So a lot more than what's needed for here. So again, this is the 1095A. It's mainly data entry once you get it in place. So it's not a lot of mystery from this point when you have the form. Again, MHCPA plans, eligibility is at or below 200% of federal poverty level. Completed through MNsure, lower no monthly cost insurance, and over 20% of Minnesotans, more than 1 point, are covered by a Minnesota healthcare plan, and a large percentage of the customers we serve. MNsure premium tax credit, under 1% of PNP customers file with the PTC. Essentially what the premium tax credit does is I think there might be a slide coming up here. It reconciles whether or not someone got advanced premium tax credit. So what people sign up for is a health insurance at a certain rate. What they don't always realize is that rate includes or can include advanced amount of the premium tax credit to help them have more affordable health insurance. So then they would get a 1095-A. It's used to fill out Form 8962. The advanced premium tax credit, though, is calculated on predicted income. So when they go to apply for health insurance, they say, I anticipate making this much amount per year. The actual premium tax credit is calculated on actual income. So if they paid too much of the advanced premium tax credit, they need to pay it back. So if they essentially said they made they're going to make $30,000 and instead they make $40,000, they got too much credit and they have to pay it back in their taxes. If they said they got $30,000 and they only made $20,000, then they may be eligible for additional credits. So the net PTC is refunded as a refundable tax credit if they get money back. So it's all generated and calculated here. Part of the issue of what's happening next year is that there are limitations to how much people are going to be charged to be paid back. And that is in place now, generally around a lower amount of what people are able to, where they cut them off from being able to pay back. But those cliffs or those cutoffs are going away at this point in time. And so, especially for people in higher income situations, they may have a lot of money to pay back. Next year, I should say. When they file their taxes in 2027 for their 26 tax returns. Premium tax credit is out of scope for any shared policy allocations that are not for people not listed on. If people are on the 1095-A and not on the tax return, unfortunately, that return is out of scope. Essentially, they have to split up the allocations for all those credits, and we're not able to do that in the software or for them. There's also a situation for self-employed health insurance deduction is out of scope if the taxpayer received premium tax credit. It's actually this circular tax credit that keeps going forever and ever ongoing throughout. So essentially it's the health insurance deduction lowers my AGI, which lowers my premium tax credit amounts, which lowers my health insurance amounts, which lowers my deduction, it just keeps going like that in a circle forever. And so it needs some sort of strange calculation to be done that is beyond our capacity here. So that's the fun of taxes. Okay, a few other small, quick items before we call it good. Cancellation of debt is an advanced topic. A COD, cancellation of debt, is in scope for canceled personal credit card debt. Other things like auto loans and many other cancellation of debt for business purposes are out of scope. The Form 1099-C reports discharged or canceled debt. And it must be reported as income on the tax return. And in fact, the only way that people can say that it should not be reported is by claiming insolvency, which essentially is a statement that when my debt was canceled, that all of my assets are lower than the total debt owed at that time. It's essentially saying that if you sold or liquidated everything you own, could you pay off your debts? And that may or may not be the case for many people. However, determination of insolvency is out of scope. But we can point people to if this is a possibility, and especially if there is a large amount of canceled debt, it may actually be worth for them to go pursue this, and they may need to go to a paid preparer to do so. But if they have a lot of canceled debt, it may be well worth it to do that. The 4012 includes a worksheet to do a rough estimate or to give them some homework to do to take and to go and to do where whoever else is going to help them with that. But they must be referred to a paid tax preparer at that point. Canceled student loans is in scope. Essentially, at this point in time, federal and state taxes don't. It's not on the books. It's not included in taxable income on the federal or state return. It's still included as household income if someone is filing the M1PR for a property tax refund. That's the only place it currently exists. Otherwise, nowhere. Foreclosures, like we said, refer them to the self-employment clinic. There are often canceled debt amounts within that calculation. And just some smaller advanced topics. All right, tip income. When we're talking tip income here, we're talking about income that is for an employee of a business when the income is not included on the form of W-2 or is not included in the employer calculations of their income. In this situation, the taxpayer must have tracked the total tips that were not reported to the employer. A tip log can be recreated based on taxpayers' best estimates. Tips are reported on Form 4137 after entering them in tax layer in the W-2 section. And then Social Security, Medicare taxes are calculated at that point in time to add to their tax bill. Tip income that is reported on Form 4137 can be used as a deduction starting in tax year 2025. But it's still very rare that this happens or is the case. If a tip income amount is included on W-2, it is a basic tax topic and does not need to be done by an advanced preparer. It's just data entry. And that includes as well the new tip deduction, which is just from box 7 on the W-2. Schedule K1. These come out at random times. People show up with them in March or April. They're like, I got this tax form. You're like, of course you did. But most or many items on K1 are actually out of scope, just because there's all sorts of different possibilities of what and how. A lot of times it's data entry and it's very simple, and a lot of times it's not. It may in scope are more often when it's things like interest and qualified regular dividends, short-term or long-term capital gains or losses, and some royalties. But generally, most generated income is out of scope, unfortunately. The 4012 does have a good layout for what is in and out of scope. There's the OOS, out of scope. And if it's labeled on that on the form that you have, because there's at least three different types of K1s, and you want to find out which one it is and compare it to the one in the 4012. And you can see if it's in scope or not. And then from there, it's data entry in the software. So it's not complicated. Residential energy credits. This is expiring as of tax year 2025. If you want to claim the residential energy credits, you need to purchase your new furnace in the next 2 weeks or the next 3 to however it is before December 31st, because otherwise the residential energy credits are going away. So purchase of qualified energy efficiency home improvements can qualify for a non-refundable credit on the federal side. Things like insulation can include the cost of the item and the installation costs. Windows, doors, insulation. Each item or category has an annual limit. Prior to the 2023, it had a lifetime limit, but not anymore. They may fill it out in the intake sheet. It does take a certain energy rating to qualify. So something has to be specifically qualifying. There are websites you can go to verify if a furnace or a water heater or other air conditioner item qualifies or not. But in generally looking at windows, doors, insulation, and the costs of that. And there's a way to enter that in the software. Some of the last few items may be off in the manual, and we apologize for that and not getting them all the way there. So they're updating in the moment, on the fly. residential energy credits is two parts. There is a resident energy credit and then an energy efficient home improvement. Part one covers items like the solar panels, wind turbines, battery storage, and that is out of scope for Prepare and Prosper. Part two covers the more basic parts of the credit, the windows, doors, insulation, and such. But all of these items are being eliminated or removed from tax possibilities as of the end of this calendar year. Okay, let's do a brief activity and then we'll just be on our way. So just again here. So we're thinking about, is it basic, advanced, out of scope, self-employment? What is happening? So Diamond has 2 children and both are in college. She will claim them both as dependent and she has Form 1098T for her each child. Last year she got a tax credit for her older child in hopes that they're both working on 4-year degrees. Is that basic, advanced, or out of scope?
Basic.
That is a basic tax return. That shows you how this goes, in that can be one of the more complicated things you encounter at any point in time, is dealing with that. We'll have a heads up, we have a new calculator to help you with the calculations for that. That should help deal with that in a much more effective and efficient way, but it is still complicated and harder times than many advanced topics. Let's see here. Charles works as a self-employed house painter in addition to working as an employee in a UPS warehouse part-time. He has a 2-car garage at home and dedicates half of it to storing supplies for his business. He made $8,600 last year painting and $31,000 working at UPS. Is that advanced, basic, SE, or out of scope? That is going to be self-employment, correct, mainly in this one, because of the business use of home. Or business use of garage is same thing as business use of home. His property itself, absolutely. All right, Scott graduated from college last year and started working as a computer programmer in September. His income from work was $26,000. While he was in college, Scott opened a few credit cards and couldn't keep up with payments. In May of last year, he remembers getting a letter from one of his companies saying he didn't need to pay the remaining balance due. And in January, received 1099-C showing 1126 as discharged debt. What is that for, y'all? That is a cancellation of debt, which is an advanced topic. And again, a lot of this stuff, advanced basic, will be easier because they're filling out the IRS intake sheet and it has an A or a B next to it. And so that's also a good thing. The reason why to become advanced is that as long as it's not out of scope, you can start taking it on. It doesn't matter what side of the equation you're on. All right, Chrissy is 48. Last year, she took $2,000 out of her retirement account. She needed the money to pay an arborist to remove 2 trees that were at risk of falling on her home. Chrissy also has a W-2 showing wages of $37,200. That's a tricky one. Honestly, I have no idea if that would count as an emergency expense or not. If you're anticipating that something would happen, my guess is that it's probably not. It could be an emergency. If it is, then it's advanced. If it's not considered an emergency, then it's a basic return. Kyle worked in a full-time job as an employee at a construction firm, but was laid off during the winter months. In addition to the $49,000 he made while working, he collected $5,400 in unemployment and $12,300 as an Uber driver. While he was off work, he made some major improvements to his home to make it more energy efficient. He installed new windows and door and a new furnace. SE, although it is it may be just out of scope for income, but I guess it might be in there. But it's definitely referred to the SE clinic because of the Uber income. All right. So just an example of things. Some of it's sorting through what people have and don't have and figuring things out from there. All right. Are there any other questions at this point in time? Otherwise, encourage you all to take advanced certification tests when you feel comfortable doing so. And also attend a What's New training if you are new or if you are a returning volunteer, so you can get a little more in-depth knowledge on the new tax items and new Prepare and Prosper items that are going to be coming this year. And other than that, I think, Holly, did you have anything else you wanted to say?
Actually, I have for you all in the chat, hot off the presses, important information about your IRS certification tests. So there's a link here to some things you should know about how the tests and all the information on the tests are on information that was, maybe Willie said this at the beginning, prior to the new tax legislation being passed. So take a look at that. It also includes some errors in the printed 6744 test booklet. So the IRS wants you to know that there's some errors that they are correcting. And Jerry, I believe we got an email from you about this today. So hopefully this info clears up your question.
A lot of this, some more of the things that are of issue are on the basic test. So that's another reason to just take the advanced test because you don't have as much issue with what is wrong. But essentially the thing to be aware of is that the 4012 IRS publication is based on information from before the tax bill was passed at the federal level. And so it doesn't have anything of the new amount of new items, and in fact has the standard deduction amounts from before the bill was passed, so that what it was going to update to instead of what it did update to. And then but the thing about it is they want you to take your certification tests, basic especially, based on the information in the 4012, which is old, which is not actually what is going to be in live tax clinic operations. Yeah, so it's just the current state of the IRS kind of in a nutshell in that one statement there, that yes, the IRS is specifically stating to use outdated information to pass your certification tests. So pay attention to that information that Holly sent. And like I said, it's mostly on the basic tests. The advanced tests not as affected by it. But other than that, I think we're good to go.
Yeah, and just to like make me smile, I'm wondering if on our way out we can count down from 3, turn our cameras on, unmute, and just wave goodbye and some sort of like closing salutation to each other. Okay, are you ready? 3, 2, 1.
Bye.
Good night,
Bye-bye.
everybody.
Bye. Thank you.
Thanks for
Bye-bye.
being here. Fun to see your faces. Catch you on the flippity flip.